Hello, and welcome to today's New Capital webinar, Q1 Review and Market Outlook. I'm Catherine Barr, Director of Communications here at New Capital. I'm joined today by Jaycee Davila, and who many of you have already met before. She started with New Capital last September, and she is beginning to take on more of our communications projects. So she's sitting with me today to get a feel for hosting webinars. So thanks for being here, Jaycee. As always, the Q&A and chat tool are available for questions. If you came to the webinar today with questions that you would like to have Leonard review and answer, feel free to go ahead and put those in now. Also, if any questions come up during the presentation, go ahead and type them in now. Don't save them for the end. And then we'll review all questions and answer the questions at the end of the presentation. So if something's already on your mind, go ahead and submit it. And if anything comes up during the presentation as well, feel free to use those tools. And also today, we're going to have you start by answering a quick poll, and Leonard will review the results as he gets started with his presentation. While you all are doing that, I'm going to go ahead and read through the following regulatory disclosures. This New Capital presentation is being made available for educational purposes only and should not be used for any other purpose. The information presented does not constitute and should not be construed as an offering of advisory services or an offer to sell or solicitation to buy any securities, related financial instruments, financial services, or other services in any jurisdiction. Past investment performance is not an indication of future results. Wherever there is the potential for profit, there is also the possibility of loss. Certain information contained herein concerning economic trends and performance is based on or derived from information provided by independent third-party sources. New Capital believes that the sources from which such information have been obtained are reliable. However, we cannot guarantee the accuracy of such information and have not independently audited these sources. Okay, thank you. And we will go ahead and bring in Leonard.
Okay. While you all continue to answer the poll, let me say good afternoon to you. I also want to say a few words about New Capital's staff to start with. First and foremost, we are all incredibly lucky to have the incredible people working at this company that we do. I think a number of you know that I was on an extended trip in March when the current crisis began to break out, although I would argue it's been coming longer. And everybody here is working as hard as they can to do whatever needs to be done to help our clients, as we always do, but especially right now, as if people need money moved or wire transfers made, trades made, hands held, meetings held at the spur of the moment, whatever it is, the answer is invariably yes, we can. Yes, I will. And so I want to thank absolutely everybody here for all the hard work that is going on, and I just can't say enough about our staff here. I am really lucky. I get to come in every single day and work with the very finest people, and it's a delight. Yes, work is hard right now. There's no way around that, but it's okay. It's good work. And what really makes it tremendous are the people that I get to work with. So to Jaycee and to Catherine and to Casey and now to Daisy. I know we've got a lot of AZs, but we can't get enough. Okay, with that, maybe the poll is ready. I do want to say, I think we've got our biggest attendance in New Capital's webinar history. And, you know, one of the reasons we do the webinars each quarter, even when there's not that much going on is so that we, number one, give you information at all times, but also so that we have an expertise in them so that when we have times like this, we're ready. Okay, the tariff question, when will the crisis abate? Most people say a year. It's going to take a year. Fully 50% of you think it's going to take a year. Nobody thinks it'll be done in a week. One person out of 32 thinks in a month, 4 people in 90 days, which is the time limit that, or the time extension that the president has given before the heavy-duty bazooka tariffs come on again. Fully half of you say 1 year. And 11 of you, a very significant amount, a third of you think it will never abate. Never. We didn't give you other choices like 2 years or 4 years or anything, you know. But literally a third of you think it will never abate, suggesting that it will have lasting, everlasting effects. And those arguments are being made really all over the place. Number 2, will the U.S. and China make a deal? Half say yes, half say no. So 50-50 proposition, according to this group. Number 3, how much farther will the stock market drop from here, from where it is now? Nobody thinks that there are no further drops. I didn't ask, does anybody think it'll go up? I could have asked that, but I figured I wouldn't get any takers on that, but I might have. A quarter of you think that we've got another 10% down. Almost half of you think we've got another 20% down from here. Good number of you, 22%, think we've got a 30% leg further down in the stock market. 2 of you, 6%, very small number of you think 40%, and nobody bid on 50%. Nobody sees 50% downsides from there. I will tell you that in the Great Depression, from October of 1929 through 1932, the stock market fell from its peak approximately 80%, 80%, which was an annualized return over those years of minus 27% each year. I'm not saying we're facing the same situation, but I think as everybody has been educating themselves about tariffs in history, the last time we had significant tariffs in U.S. history was at that time in 1930, the passage of the Smoot-Hawley Tariff Act of 1930. And what ensued was the most difficult financial period in modern American history, and really what marks the beginning of modern American economic history. Number 4, how much higher will the 10-year Treasury rate rise from here? You all may have heard that we're getting a rise in bond yields, which is something I've written to everyone about beginning maybe a couple months ago with my first piece this year. And I wrote that I was concerned that we might see a rise in Treasury bond yields if confidence in the United States fell. And unfortunately, that is proving to be the case. 3 of you said we'll see no further rise in the 10-year Treasury bond from 4.5%. I didn't ask if we would see a drop in the 10-year Treasury bond yield. We could see that, right? If we have a recession or worse, we could see bond yields drop precipitously. Some of you may believe, but I didn't ask that. I asked if we're going to see an increase. So 3 of you said 0%. 10 of you 31% of you think we'll see another 1% rise in the 10-year Treasury. 50% of you, most of you, or a plurality, half of you think we'll see a 2% rise, which would take the 10-year Treasury to 6.5%. And why is that important? Because the 10-year Treasury often is looked at as a benchmark rate. All other interest rates tend to be gauged and priced against the 10-year Treasury bond because it has been regarded as a risk-free instrument. It is without risk in history. The assumption is that the United States, as the strongest nation in the world, the most stable government and democracy in the world, that debt issued by that government represents the most stable risk, the investment that is most characteristic of lacking any risk. And that may be in jeopardy. And then a few of you think we'll see even higher rises in the 10-year Treasury. Mortgages are priced, right? So 30-year mortgages are priced in relation to Treasury bonds, and business loans and private loans and credit card rates. All these other interest rates are priced in relation to often, not always, but often priced in relation to Treasury bonds. Okay, number 5. This year, people expect inflation to rise by how much from the current about 3%? And most of you, or rather a plurality of you, 41%, see another 2% rise in inflation, which would take it to 5% for the year. And some of you see increases even more than that, 3% above the existing 3, take it to 6. This would represent right here 7. And quite a number of you, 7 out of 32, think we will see even higher inflation, meaning higher than 7% inflation. To remind everybody, the recent large bout, and I'll show you a slide on this in a little bit, we were close to 8-9% back around 2022. Right now, I want to, 3 of you say I want to sell. Most of you say I want to hold. And this is important for us to know because we've put everybody in a portfolio that we think is the right one for you. But we'll talk about that also on this call. And an equal number of you want to buy as sell. And we've had some clients, not a ton, but some interested in buying securities at these lower prices. I think I mentioned in my memo that I sent out the other day that I had personally bought a little bit extra in my personal account. But I also said that everybody's different and everybody's has to make a decision that's right for them. And so I'll talk about that too. Okay, thank you very much for the poll. We went through that. My first slide here is life goes on. I think I just wanted to start with this. This is really, really important. Life goes on. We have politics dominating a lot of our lives, and now we have economics dominating a lot of our lives. But this was last night here at the White Oak Music Hall where the band I play in, the Overcommitments is the name of the band, which is certainly true for the guitarist. And there's the crowd you see. Very, very, I wouldn't say it was a fully packed house, but not far from it. A really, really nice crowd. It was a benefit concert put on by bands that have lawyers in them. We have 1 or 2 lawyers in our band, and so we were eligible to play, and we did. And I'm happy to say that we won the judges' prize for the best band. And we really had a great time, and we all played great. And it was a happy night. And you see smiles there. And I just want to remind everybody that it is really important. If you are not doing things that make you happy, if you are not having experiences that are putting a smile on your face, please try to do that. It's really, really important to do, because that's what refreshes you. And that's what puts you in a position to be able to think more clearly and to take on work and finances and politics and relationships and all the other important things in our lives. So please know that life does go on despite all the incredibly um, uh, powerful and often upsetting things that are going on in the entire world right now. Okay, a few updates. Reports for Q1 are out on NCM 360, and so you can take a look at them. By and large, and Jaycee's going to talk about this in a second, our portfolios did a terrific job in the first quarter. And but that doesn't mean that we were able to avoid getting some rain on us. But we did not, by and large, get drenched, and that is really owed to our investment approach, investment philosophy, and boy, did it pay dividends in the first quarter and continues to on a daily basis. Bullet point 2, we have been asked by so many clients if we can make recommendations on CPAs. And I've said that it's not a simple time in that business. There's been a lot of attrition in the business as younger people have decided they didn't really want to stay in accounting, as senior partners have retired, and as other young people decided that they didn't want to go into accounting. The numbers have been reduced and fees have gone up. And we have had a good experience. One or two clients we've referred to Melissa Thorell at H&R Block. Melissa is one of the top, maybe the top preparer for H&R Block here in Houston. And so if you, as we approach tax deadline, still need some help, we'll be happy to put you in touch with her. And we've had some very good reports. I had a meeting with her and really liked her. And while my family's not using her for various reasons, we're a little complicated. If you're more straightforward in your tax accounting, Melissa's great. A reminder that our meeting reports after we meet with you are now in NCM 360. We have an incredible new feature. Some of you may have been getting automated reminders that are now coming out of NCM 360, reminding you about things in your financial life, whether that's IRA contributions or tax returns that might be due. And I want to thank everybody here, especially Catherine and Jaycee, who have worked very hard to get our reminder system up and running, and it's only going to get better. A reminder to everybody, NCM 360 is great, and it can help you do a lot of things, and it can keep most of your information about your house, about your vehicles, maintenance on those things. It can keep trust and will information and information on business entities and tax returns. There's a place to store all of that on NCM 360. And finally, of course, April 15th is coming up. So there are deadlines for tax returns and IRA contributions. If you need any help at all, we've still got a handful of days left. And so if you're running behind and have any last minute things that you need to do as we approach April 15th and we can be helpful, please let us know. Okay, with that, I'm going to turn the webinar over to Jaycee for her presentation. And Jaycee's going to talk about how our model portfolios did in Q1 and maybe a few other things about them and their composition. Welcome, Jaycee Smalley, Vice President of New Capital Management.
Thank you, Leonard. Good afternoon, everyone. Thanks for joining us during your lunch hour. As always, I'm going to take us through the performance of our model portfolios over the prior quarter. I wanted to start with actually a reminder of, I thought this would be interesting to see the difference between Q4 of 2024 versus Q1 of 2025 performance. So I started with this Q4 2024, and you all might remember that the US market had a super strong quarter. You can see in the yellow and the red there, the higher model number, the higher equity stock allocation in the portfolio. And so you can see that the US stock market had a very strong Q4 2024, up over 2% there. Whereas global international portfolios, they had a little bit of a weaker quarter there, down about 2%. So kind of a mirror image of each other. And I'll remind you, the global portfolios include both US and international investments, whereas the US only obviously is not going to have any of the international investments. So I wanted to start there. And then if we will go to the next slide, here is last quarter, Q1. It is kind of a reversal. So you can see the US stock market really struggled in the first quarter of this year. It lost the gains it had in the quarter prior and then some. So, the US stock market down almost 5% there. But again, the global portfolios really held up. They weren't, they didn't eke out much of a positive gain, but overall, unless you were holding bonds did do very strong. The first quarter there, up almost 2%. But the global international stock allocation really held up. And so you can see that, you kind of broke even there towards the end of the charts there, versus if you had held a US only portfolio where you would have been down over, 4, almost 5%. And here, what I'll show you here is that we have some partners that you're familiar with: BlackRock, Vanguard, Dimensional, DFA, that we all have model portfolios. And so in the first quarter of the year, this is looking at our Model 5. So that's a 50% stock, 50% bond portfolio. Our new capital portfolios were up almost, 70 basis points there. BlackRock about 30, up 30 basis points. Vanguard up about 60 basis points. DFA flat there. So we did, really well compared to partners in the first quarter. So we always want to show that. And then if we want to dive a little bit deeper into that, well, first let's start with this. We'll start with the US versus international stock performance. So that's what this chart's showing year to date. This is as of this morning. The blue line there, that represents the US stock market, the fund that we use for US holdings, down over 12% year to date. That's a huge number. If you look at the yellow, that is our international holding. It was flat. So that's really staggering, a 12% spread between the US and international stock performances. And so that's why, the global portfolios have, they've held up over the quarter, year to date. And they've really, small gain, but they've done well. You're not in the down 12%, 10% range. You're not taking that total hit in your portfolio. And so if we dive a little bit deeper compared to our partners here, I'll show you why that is. So our portfolios right now are divided between US and international stocks, the equity allocation. 60% of our stock allocation is allocated to US stocks and 40% to international. If you look at our partners, BlackRock and Dimensional, you can see they have a much heavier allocation to the US stock market. And so that's kind of what, that kept them down over this past quarter, this past period. Vanguard is very similar to us, 60% US, 40% international. We're even considering maybe a slight increase into international even further. Leonard and I have been thinking about that for a couple months now, a month or two. Do we want to take that a little bit further? Here, I'd like to talk about our diversification. So you can see that we invest globally. So the funds that we hold are invested in 45, maybe more countries. Maybe you can see most of it's still in the US, North America, but we're all over global. And that represents about 13,000 companies. So I put all the numbers in together today, added them up and saw, that's a huge number, 13,000 companies that your portfolios are invested in. Bond diversification, same picture. We are globally diversified. 25 countries for bonds, 24,000 issuers, bond issuers. That is, that's just a huge number. We're so diversified. Again, mostly North America, US, Canada, but still we've got UK, Asia. So sorry, Leonard, I was going to use your school of fish investing analogy that you usually tell clients.
Well, that's right, Jaycee, that I do say that this approach, this highly diversified approach, is really, really critical right now.
Mm-hmm.
As everybody knows, one man can wake up on a particular morning and decide something that's going to have an impact on this industry or that company or this country. And we can't predict what he's going to do, what the target of his beliefs and at times his ire is going to be. But we're trying to do our best to make your portfolio look like a school of fish, so that if one fish gets picked off, and undoubtedly there will be fish picked off, that doesn't really harm the integrity of the school itself. And the two slides you've just given us are designed to convey that to everybody. We know that we can't solve political problems here at New Capital. I wish I could, but that's not anything that we're charged with here. We're charged with taking care of your capital. And right now, taking care of it means keeping it as safe as we can possibly keep it, as safe as we know how. And I think we're doing a very, very good job of that. And we wanted to show you that the numbers say that. It's not just words that we're using. We're showing you that with the numbers and with the theoretical basis behind it. So, Jaycee, thank you for putting these slides together. Really, really incredibly helpful.
Of course.
I'm going to turn now to the crisis itself and show some slides. This is the trade balance, and I know that everybody is becoming an expert on tariffs, right? Just I'm having to do it too. I certainly didn't know, a few months ago, anywhere near what I know now, and I wouldn't say I know a lot now, but I'm learning more all the time. We're all having to become experts in what was an arcane field, frankly. Something that a tool that was really not used for the most part in the world, and which during my lifetime had become a really, really unused tool, something that generally stayed in the toolbox and was at the bottom. And yet suddenly here it is becoming, the news of the day. And so everyone is having to become experts on tariffs, me and you and Terry Gross and the late night comedians and your family members and friends and so on. I guess we're all going to be tariff experts. But this is a graph of the U.S. trade balance. This shows that here in roughly 2024, the U.S. exported roughly $3 trillion in goods and services. Goods and services. Goods being this light yellow, but also a very large amount of services as well. Very significant part, I would say a third, according to this graph. $3 trillion, to put that into context, is a lot of money. The United States has a gross domestic product, which is the measure of economic transactions, goods and services, as well as a few other things, and I'll show you a graph of GDP in a second, of $27 trillion. So of our GDP, $3 trillion is contributed to by our exports. And you can see that we have imports of roughly $4 trillion. $4 trillion of imports versus $3 trillion of exports. And you can see as well that the vast majority of our imports are goods, right? Whereas a smaller percentage are services. It's not nothing, but by far what we import more of are goods. And therefore, if we import $4 trillion, but we only export $3 trillion, then we have a $1 trillion deficit. And you can see that on this black line. This, therefore, is the net of exports minus imports is the deficit. Exports minus imports is the deficit. Since we import more than we export, we're in the negative. And this is what is exercising our president to such a great extent. This line right here has got him hopping, mad, and upset. $1 trillion deficit that has grown. It has grown, to be fair, it has grown over time from, the year 2000 when it was maybe $250 billion. But the size of the economy has grown also, and the country has grown also. And currencies have depreciated also, right? So the dollar's worth less. So to transact the same amount of goods and services in quantity and in volume is going to take more dollars to do it in today's dollars versus in prior dollars. So $1 trillion trade deficit is what has got him to the point where we are going to have to take the action, according to him, that we are taking. Now, is this a problem? There are debates among economists as to whether this is a problem. Many economists, and I'm not an expert in trade deficits, either in trade deficit for philosophy or mathematical theories of trade deficits, but that there are arguments that us running a trade deficit is not a problem. Warren Buffett, I think, and I haven't gone back, but I think maybe 20 or 30 years ago, maybe in the 1980s, when there was a large trade deficit with the country of Japan at that time, you all may remember when there were fears that Japan was going to take over the United States. We laugh at those fears now, but that was the fear back then. They bought Rockefeller Center, and this probably sent Donald Trump, who then was plying his trade on the streets of New York, into paroxysms of fear and probably hatred at that time. And we know that the Japanese did not end up taking over the United States. What actually ended up happening is Japan, beginning in 1989, actually fell into a lengthy recession, and has only recently started to show signs of emerging from that. But nevertheless, that was the fear with the Japanese trade deficit back in the 1980s. And the same arguments were being had at that time about whether trade deficits were harmful or not. Okay. And so there are arguments that it's not a big deal, that we're a big country, that we have a lot of needs. Our people are in a wonderful position to be able to command forth goods from other parts of the world, including China, and that other countries in the world, are willing to take our dollars, an IOU, a piece of paper, against the Treasury of the United States, that they are willing to take these pieces of paper in return for things that we use, like the table behind me and the lamp over there in the corner and the chairs. I'm not saying all these are made in China, but maybe they weren't all made there. But as we know, one of the problems is that there are parts of the United States that have seen their jobs or jobs that they held, there has been job losses in those places, and those jobs have gone to other places in the world. And I don't want to minimize that at all. We are sympathetic to it. The question is, how do you solve it? I want to give everyone a look at GDP. And by the way, we may go long on the call today. I think we've got it scheduled for an hour, but there's a lot to cover. And so my apologies in advance. I really want everybody to be in possession of some facts. That's really the main thing I want to do here, as well as talk about what we can do for you if you want to make some changes or are deeply, deeply concerned and worried. GDP, gross domestic product, is the most common measure of an economy, and this is showing you the growth of our GDP. So in 2001, our GDP, our gross domestic product, was around $14 trillion. And we're now pushing up toward 24, this is showing 24 trillion, but I think we're now around $27 trillion. That's been the growth. You can see the trend line growth is about 2% on average a year for growth of an economy that's the largest economy in the world. So Donald Trump's claim that we are an anemic basket case is belied by this. Now, this is not to say that we don't have issues, and everybody knows that the distribution of wealth in the country and the distribution of income in the country there are issues. Again, the question is, how do we fix things? How do we fix things? But automatically, you can just see that the country has grown. Now, we've had periods of problems. Here was 2008, the financial crisis, when the GDP of the country took a hit, and this is COVID, when the GDP also took a hit, but returned. Over on the right, you can see the components of gross domestic product, and the thing that stands out immediately. I don't even need to say, I don't need to describe it, but I will. 68% of gross domestic product comes in the form of consumption. Now, I'm not saying that's a good thing or a bad thing. There are those among us who would say that we buy too much junk. I've got stuff in my house, and, Hannah will tell you that sometimes I complain that, can we do with a little bit less stuff? But, I'm as whatever, guilty, if you want to call it, as anybody. And I ordered something from Amazon overnight, but we need it. And it's good that I can get it. So 68% of gross domestic product is consumption. Well, if you put tariffs on everything in the world, which is what is being proposed, we can assume that this is going to be impacted at the very least. The next sliver in this stack chart is 6.5% federal government spending. You may or may not know that government spending is one of the contributors to gross domestic product. And why not? If the government spends money, that's an expenditure. Hopefully the government is spending money on things that are important and give a good societal return. Why would we exclude government expenditures from GDP? Now, you would think from certain political talkers here in the United States that government spending in this country absolutely is drowning out everything else in this country, and we are being taken over by government spending, local, federal, state level spending. But take a look, everybody, it's 6.5% of gross domestic product. I don't know, is that not a reasonable amount of spending to do in an advanced country? It at least begs the question. Here's state and local spending, 10.7, right? So if you put these together, we see that we're spending about 16%. But you see that the federal government is even smaller by almost half of state and local spending often being spent on infrastructure type projects and schools and airports and, fixing potholes here in the city of Houston. 13.8% business investment excluding housing. Business investment excluding housing, and then 4% of gross domestic product in housing, right? So let's think about this. We've got tariffs that are going to impact consumption probably negatively. We have the Department of Government Efficiency, DOGE, going around minute by minute and doing, according to it, slashing of government expenditures, which is going to negatively impact this. We'll see what happens at the state and local government spending level. We're hearing from businesses left and right that their plans are on hold. And nobody's making any decisions right now. So we can interpret that as being a pause on investment, business investment spending. And here's housing. If we get an increase in housing costs, which by all accounts we're getting in terms of materials that may be required, whether it's cement or steel or wood or whatnot, wood coming out of Canada and cement coming out of Mexico, et cetera, we might see negative effects on housing. And so it's hard to see that any of these components of gross domestic product are not going to be negatively impacted by the policies that are both being proposed and actually undertaken by the Trump administration, with assistance, of course, from a Republican Congress. It's hard to see that we're not going to get what would be called a recession, where this line of gross domestic product drops. I don't think that's what voters who supported Donald Trump were expecting, but more than likely that's what they're going to get. Now, you may ask, where are exports in all of this? Dun, 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 dun. There it is. Net exports. Remember, I told you that we have a $1 trillion, I showed you in the slide before, we have a $1 trillion trade deficit. I'm not saying it's a good thing. I'm not saying that there shouldn't be some well-intentioned and well-thought-out plans and discussions to deal with that. But you can see that the impact on gross domestic product of almost $30 trillion is minus 3.1%. And yet it has become the most important economic issue for the President of the United States. Household balance sheets. These are the assets of households in the United States, $190 trillion. Remember, I told you that gross domestic product is 27 or $30 trillion from the slide before. That's a flow. That's income. You can think about it that way. This is the balance sheet. These are the stocks of our country, almost $200 trillion in economic stocks. Homes account for 27% of that, and other tangibles that, I don't know what that is, gold and cars and boats. Money on deposit in banks, 8%. Pension funds at 17%. Other financial assets, we might think of that as stocks and bonds and insurance policies. 43%, the single largest component of consumer balance sheets. And I understand, of course, that things aren't distributed very evenly and very equally in this country, and that 50% of the people in this country have almost none of these things. And anyone who knows me knows that I don't stand for that in my beliefs, that I have lived my entire life trying to think about how to make things fair. But I'm not in a position to blink my eyes and snap my fingers and make that happen. This is the situation here. Now, in the last weeks, we've had what? 6 trillion, 10 trillion of this value destroyed in order to solve a $1 trillion trade deficit. You have to ask yourself, is that really the way to go about solving a $1 trillion trade deficit, by taking actions that are leading to destruction in the asset value on this chart of $10 trillion and counting? Here you see in this column liabilities. These are mortgages, mostly debt on houses right here. Let's look at inflation. Here is the picture on inflation. Everybody knows we really went through the ringer here in 2022 when we hit a peak of 9%, but it came down and has come down month after month after month after month after month until January of 2025, when Donald Trump was inaugurated. And you can see the components of inflation have been changing. Look, we had inflation in 2022 of virtually every component, energy and shelter and food at home. And everybody remembers that period, core goods and so on. And now energy, oil prices have actually fallen as there are concerns that we're going to fall into a recession and where people are going to be demanding less heating fuel and less gasoline and so on, driving less. But you can see that inflation has been under control, and now there are concerns that it's going to get out of control again. And you all voted in the survey that we're going to see inflation closer to this than we're going to see where it has been in the most recent past. The federal budget deficit is, of course, in the news. And we can see we have a big problem with deficits. This is all the spending, total government spending on the left. Social Security, $1.5 trillion a year, and Medicare, $1.1 trillion, Medicaid, $656 billion, other mandatory spending, $855, non-defense discretionary, $989 billion. This is where these two areas are where Elon Musk is doing a lot of his work with his group, because they've decided nothing here and nothing here is worth spending on. Here's the defense budget, $859 billion. And here's how we pay for all this. Oh, and then here's interest on debt that we've issued, $952 billion. Very, very significant component now. The country hasn't wanted to raise taxes to pay for all this stuff. And so people across the world have bought bonds and been willing to loan our country money. We'll see if that continues to be the case. And here are the sources of financing: income taxes, $2.6 billion, payroll taxes, $1.7 billion, corporate taxes, pretty small, 7%, $524 billion, and they want to cut it further. And then we have a deficit here that has to be made up. And tariffs, $80 billion in tariffs. And so this is what the president wants to do, make this a much bigger source of financing. His idea is that tariffs are going to come through and do the job. I titled this slide Psychological Projection. This is from the New York Times. This says that for days, Mr. Trump and his top aides had foreshadowed the chaos and confusion now playing out across the global financial system. The president repeatedly had described the U.S. economy in medical terms, saying the nation was, quote, sick and needed a painful yet necessary corrective to boost American manufacturing and generate revenue. And my only comment here is that psychological projection, referring to this word right here, is defined as a defense mechanism in which an individual attributes their own unacceptable thoughts, feelings, or behaviors to others. I've shown you the graphs of gross domestic product. You yourself can determine whether we're a sick country or not. This is a graph that shows you the situation of tariffs. This is the line of reciprocity. And what this means is that a country that has equal tariffs imposed on it by us as it imposes on us would be right on this line of reciprocity. Here's Canada, and here's Mexico. And this is what has everybody asking, why are you hitting them with tariffs? We're equal on this line. But they're not alone. Taiwan is very close on that line, and Japan is very close on that line. And so people are asking, why do you want to assess tariffs on allies of ours who are on this line of reciprocity? The EU is very close to the line of reciprocity. You can see that right here. It's a little bit shaded toward the EU, but it's not far off. So you could have a reasonable discussion with them about, how do we get to there? Everybody can see up here that China is not on the line of reciprocity. So the president may have a good argument that the tariffs are unequal. But there are already 10% tariffs on China, and China looks like it has about an 18% tariff on the U.S. So while it's not equal, it's not nothing. And so we are collecting tariffs on China. Just wanted everybody to see what the picture is here. Brazil, India also not on the line of reciprocity, but it does beg the question. Here's Vietnam. Vietnam's been in the news a lot. It's very, very close to the line of reciprocity. And so here's all countries. By and large, if you take all the countries together, it is being pulled off of the line of reciprocity, but not by an enormous amount. It basically looks like the U.S. is assessing tariffs of about 3% while paying tariffs of about 4.5% or so. So that's the degree. And the question is, do we blow up the whole system and engage in a tit for tat where tariffs are now between the U.S. and China 125% one way and 150% another way? That's the question. And you can see this is the history of tariffs going back to 1900. So you can see that way back when in 1900, tariffs were a very significant part of the financial picture of the country. These are duties collected as a percentage of the value of total goods imported. And tariffs were pushing toward 30%, right? And then we had a fall, right, around the time of the First World War, excuse me. And then they rose again. And this was Smoot-Hawley that I told you about earlier when Congress, not the president, passed the Smoot-Hawley Tariff Act. And many economists think that exacerbated or even led to the Great Depression. And you can see that after that, tariffs as a percentage of goods imported fell and fell throughout my entire lifetime. And what is the estimate of April 9th of the tariffs that the president, at least until he decided to postpone them? Look at that. No phase-in. Not telling anybody we're going to undertake this over the next even 2 years or 4 years or whatever. Blammo. Absolutely hit the entire global economy with a bazooka to return tariffs to a level that we have not seen since 1932. You can understand from this chart why we would be getting the market reactions that we're getting. And by the way, markets are working. Think if markets didn't react to this, right? Let's imagine that, everybody, right? That would be a market that would be paralyzed, right? As if its nerve centers had been destroyed and damaged, and it wasn't responding. So markets going up in response to the president, acting as a puppeteer, and markets going down are doing exactly what they should be doing. And you can all take comfort from that the markets are responding the way an airplane does. It's not the plane right now, it's the pilot. And you can see this is the Economic Policy Uncertainty Index for the United States. I'm not going to get into how this index is created. It basically is sort of derived from headline news and mentions of uncertainty. So, I don't want you to think that there's some sort of scientific derived number where we can measure uncertainty, but it's helpful, especially given that we have a time series for it and it's being kept rigorously over time. You can see that we have now, in terms of economic policy uncertainty index, surpassed COVID peak and surpassed the peak even set in 2008, which I can tell you in my career, which was early in the years of New Capital Management, 4 years after I started the company, this is the closest thing that I can compare the current crisis to is the crisis in 2008. But it's different. In 2008, you couldn't say this one person has caused it, or that this one person can uncause it and solve it with a decision. That was a very complex financial crisis where we had insolvency in banks, in the banking system, and we had a mortgage crisis and a subprime lending crisis, and there was no one person that we could point to who caused it. There were different parties that could take blame, banks and Federal Reserve and et cetera, regulators, but no one person, and no one person was able to solve it. It took a workout. And in COVID, who are we going to blame for that? Just as we knew what it was going to take to solve it. It was going to take scientists making vaccines. This one, we know how to solve it. And we saw the other day that when the president extended a 90-day extension to the tariffs, the market reacted immediately. Again, the plane is working. If the pilot pulls out of the nosedive, the plane will come out of the nosedive. But this crisis is fundamentally different than these others. Much more concentrated responsibility-wise. This is the mathematical equation for why you're seeing a fall in the stock market very quickly. This is known as the Gordon growth model. Think about this as the price of all stocks or the price of a stock. And Nobel Prizes were awarded for this equation. It's not a complex equation. It's just algebra. It's not a calculus equation. This is a dividend, right? We could think of this as dividends that are being earned by a company or by a group of stocks. This is the hurdle rate that a company or series of companies have to earn to earn their cost of capital. In other words, this is the cost they pay for their financing to run their operations. So a company might have a 10% cost of capital between issuing amounts of debt and issuing equity. And this is the growth rate of the company. And so you can see that the larger the growth rate, the smaller the denominator, right? This would be the cost of capital minus the growth rate would be a smaller denominator. And therefore, we would be dividing the dividends or the profits, if you will, by a smaller number. And therefore, the value of the company or companies would be bigger. But if we have slower growth rates, which is what is being threatened by these tariffs, this G is much smaller, which means R minus G is bigger, which means the denominator is bigger, and therefore the profits or dividends are being divided by a bigger number, which means that the value of stocks is smaller. I just wanted everybody to see that your stocks are not falling without any reference to mathematical sensibility whatsoever. I don't expect you to memorize this equation or even to say it ever again, but I just want to show you that, again, the market is functioning on a rational and reasonable basis. This is the Treasury yield curve very quickly because we're late on time. What this is showing is that right now, here in April 9th of 2025, we have an upwardly sloping yield curve where where we have had a rise recently in the 20-year Treasury bond rate and in the 10-year Treasury bond rate. We were now above where we were in 2023, noticeably so. And in the last several days, we have seen a rise in the yields of Treasury bonds. Why is that worrisome? That's worrisome because when we have had in the past COVID and the 2008 any financial crisis, the asset that people all across the world have been willing to put their money into, the safe haven, has been United States dollar-denominated assets, and especially U.S. Treasury bonds, because of the faith of the world in U.S. Treasury bonds. And that has been shaken over the last couple of weeks because both the dollar and U.S. Treasury bond values have declined. And that means when that happens with bonds, when the price of bonds goes down, the interest rate goes up, because that means that the borrower, in this case the U.S. Treasury, has to pay a higher interest rate for its bonds because it's less trustworthy, right? Right? If it was more trustworthy, then it would get a much more favorable interest rate, just like with credit card borrowers, right? Credit card borrowers, people who are heavy credit card borrowers and use their credit cards too much or a lot, have to pay a very high interest rate. Okay? All right. Real quickly, and then I think we'll turn it over to some questions. This is not happening against a backdrop, this financial crisis. I want to remind everybody, and I know you need no reminding, but I'm going to remind you anyway. It's not happening against a backdrop of just any old political background. We have what really amounts to a 50-year political backlash that began. I was born in 1965, and I don't know a time in my life when what I have observed to be a political backlash against the movements of the 1960s, cultural movements and political movements, and all kinds of movements that were taking place. That those movements profoundly rattled a large number of people in this country and began what has been a 50-year political backlash that really is now resulting in what many people call an authoritarian takeover of the executive branch of the government. Those are not my words, authoritarian takeover, all right? So please don't ascribe them to me, because historians are using those words. Deans of law schools are using those words. What we have, according to them, is an authoritarian takeover of the executive branch of the government, and it is being supported by a compliant Congress. We are seeing alliances broken, and if not broken, then stretched to the breaking point or toward the breaking point. We are seeing governance by extortion, which is to say, use of the federal treasury to get something in return, whether that's a change in the curriculum on college campuses or a change in law firm pro bono work or a change in local and state government services. Whatever it is use of the federal treasury to get something in return, and it's tantamount to extortion. We've never seen anything to this effect. I'm sure it's happened in the US government often, and I know that horse trading takes place and that lots of quid pro quos exist in politics, but I have never seen it so nakedly practiced. We have due process being eliminated. And we're seeing lawsuits that are being filed in the courts that are forcing the government to reestablish and practice due process. And even when those orders are given by the courts, they are not being heeded, and courts are being not listened to. And I don't want you all to just think of due process in a legal sense. If you think about it, what's gone on with this whole tariff crisis is a lack of due process. And I've been saying it throughout this talk today. What we have is something that has been, by all accounts, most accounts, rushed and not well thought through and hasty and excessive, and I could go on. Well, that is the definition of lack of due process. Here at New Capital, we can't practice no due process. We have to have process. We'll get to a decision, we'll get to an action, we'll get to a portfolio trade, but we have to have due process, and we have to have due process when we send you money and make sure that you're the person requesting the money and that we're sending it to the right place. And so what we're seeing all over the government is elimination of due process, not just in the legal area. And we are also seeing, in reaction to all of these things, lawsuits initiated and what I would call incipient protests. We don't have people marching in the street 24 hours a day, but we have incipient protests. This is the background to this crisis. A few other observations, and I've made these in the article or the memo that I sent out the other day. We don't have a global tariff trade war. We have essentially a U.S. versus the rest of the world trade war. And that has important implications because the rest of the world, at least right now, appears to be determined to maintain a global trading system. And that's important for us here because as we make decisions about do we increase our allocation to other parts of the world, this is a really key thing that we're thinking about, right? For your money. We have right now the institutions of the American presidency versus global markets and investors, right? We've seen the American presidency go against law firms. We've seen the American presidency go against colleges. We've seen the American presidency go against immigrants, and so on, right? Well, what we have in this crisis is the American presidency go against global markets and investors. We included. We have a role to play in this, right? And so right now, at least, I would say we are not powerful. And this 90-day the extension that was extended showed some indication that we, global investors in global markets, have some power. So don't think you don't have power. Tariffs are, however, what has become clear to everybody is that they clearly have identified. The administration has clearly identified that tariffs give them presidential control over markets and therefore over portfolios. And everybody needs to understand this. This is critical, right? This is critical. Everyone has to think about how much control do they want this president to have over their portfolio. I can't answer that for you, but it's a sobering thing that this crisis is revealing, that this president can decide, I'm putting tariffs on, market down, I'm taking them off, market up. We all need to think about that. And as far as we know, this president will be in office for another 3.5 years. Everyone's got to decide how much of the ride they want to take. Secretary of the Treasury Bessent says, it's Main Street's turn now. In other words, we don't really care about the stock market. We're going to help Main Street. I don't know why he thinks that people on Main Street don't have 401ks or IRAs. Because they do. I know they do. Because we have clients on Main Street. But that's what they're saying. And that tells you they may not care so much about your portfolio. As I've said, global markets are working for now, and that's good news, right? The markets are reacting, and I know that it's crazy making to see them go up and down, but I want you to consider the opposite possibility, that they don't react at all. Then they would be broken, and we don't want that. It's very important that these feedback mechanisms be coming from markets to this administration. They're not going to listen to immigrants. They're not going to listen to college presidents. They're not going to listen to opposing lawyers. They're not going to listen to a Democratic minority in the Senate or the House. They're not going to listen to Democratic state governors. They're probably not going to listen to Republican state governors either, and they may well not listen to Republicans in Congress either. But they might listen to markets, which means markets have to speak truth, and I think they are. People, as always in a crisis right now, are not so much concerned about what's my portfolio making, what is my return, did I get my 10%? People right now, as always in a crisis, are more concerned about return of capital more than they are return on capital. And Jaycee and I spend a lot of time thinking about that and making sure that what we're invested in for you, you get your capital back, whether that's in bonds or diversified stock portfolios. I talked about the risk-free rate. I'm not going to talk about it again. Will we see bankruptcies? I haven't seen that word appear yet, but we are always trying to be out in front. It's hard to see. We're not going to see bankruptcies. If certain companies are totally dependent on imports or raw materials that are coming from other parts of the world, or sales that are coming from other, I could go on, and if they get behind in their sales and they're not in a strong financial position with their balance sheets, it's hard to see how we don't see bankruptcies. And if we get a spate of bankruptcies, or a large number of them, not good. I want to warn everybody to beware of salesmen of alternative products, things like private real estate deals and private companies and so on. They'll come out of the woodwork right now, because what they're going to say is, oh, if you don't like the volatility of the stock market, you should put your money into these private investments. I don't want anybody to be confused. Private investments, whatever it is, they are not any more immune from global economic effects than publicly traded investments. They're just not marked to market on a minute-to-minute basis like public investments. But don't you think that they're not impacted the same way? If they were marked to market, if there was a stock market for private real estate that was being priced minute by minute, or a stock market for, private companies or private oil and gas deals, and they were able to be priced minute to minute, I promise you their prices would be moving just as much as public market assets. So please, please don't fall for that one. These guys come out of the woodwork at this time. Oh, we'll give you an asset that doesn't change in value. Oh, really? All it means is that you wake up 90 days later when they issue the quarterly statement, and the drop's like this, rather than this. But the total drop is the same, okay? This is the market response. I'm going to skip this slide. We're short on time. I want to get to some questions. I'm skipping all kinds of slides today. This is an important slide. Okay, so what are we going to do? Here are things that we can do for you. If you are retired or you need cash, we have some endowments, we have some foundations, whatever. If you feel that you need cash and you want to have a bigger cash cushion, we're happy to do that, and we can do that. We can make what's called a cash set aside, and we're giving you sort of an option. You can pick 1 year of cash, 2 years of cash, or 3 years of cash. 1 year, 1.5 years will get you to the midterm elections. 3 years will get you to the general election. And, if you want clarity of a cash position until that time, we are happy to make a cash set aside for you. We're happy to talk about that with you. In models, if you feel that we have you geared up too much, your portfolio is too volatile, we've tried very hard to get you into the portfolio that we think is the right one for you. And we've gotten lots of emails from clients saying, thank you so much. I see that my portfolio is down, but it's not nearly down as much as I thought it was going to be down. We really are grateful for those emails because you're giving us feedback, and we're getting a lot of that. Just so everybody knows, we are not getting panicking clients, and we're not getting clients telling us, you had us in a portfolio that's not the right portfolio. We've done a really good job on that because that's what we're hearing. But if you want to gear your portfolio down because for whatever reason, volatility you think is just too much, we will offer you a gear down of 1, 2, or 3 levels. So for example, if you're in model 6, which is 60% stocks and 40% bonds, we can discuss with you gearing it down so that you become a 6-1, which would be a model 5, but we're not going to call it a model 5. We're going to call it a 6-1. Why? So that we know that we geared you down during the crisis. And if the crisis clears, we could gear you back up to a 6. So you would be a 6-1 or a 6-2. We're happy to have that discussion with you. So we can give you a cash set aside, 1, 2, or 3, and we can give you a model gear down, 1, 2, or 3. We will work on tax loss harvesting. We don't have a lot of tax losses because we have a lot of gains. We've done a good job over the years of investing with positive returns. But we do have some areas where we do have some tax losses. Jaycee and I may take those losses and confer upon you a tax benefit. You don't have to do anything on this. I'm just telling you this is something that we're taking a look at. I've already told you we're looking at increasing international, and Jaycee already told you that we are already more international than any of our business partners. We're more international than the global market index, known as the All Country World Index, ACWI ACWI. So I don't want anyone to think that we haven't been international. We've been more international than anybody we know, for sure. But, it hasn't, is it enough in a first quarter when U.S. markets fall 12% and the international is flat? So, but we may do more international, both in stocks and bonds. We're thinking about that. Cash equivalents. We're making no assumptions that money markets won't hit some turbulence as they did in 2008. We're making no assumptions that even cash might not hit some problems. For example, what about FDIC insurance at banks? There have been rumblings by the Trump administration that they're going to get rid of FDIC. Well, if they get rid of FDIC, then you wouldn't want your money in a bank because that single bank could fail and there's no federal insurance. So we're being very, very careful to make sure that we don't just make assumptions about cash. So that goes with this cash set aside. We have to make sure that we're thinking in a diversified way about cash and cash equivalents also. And then finally, we're doing a lot of thinking about safe havens. What is a safe haven in a world where the U.S. Treasury is not held in the same regard that it has always been held in, at least during all of our lifetimes? Just the quick overview on current market conditions are that markets are clearing, markets are responding to actual events. That is good. International continues to be cheaper than the United States, and the United States markets, stock markets, are not yet what we would call super cheap, even though we've had a fall in them, and you all indicated you thought we might see some additional fall in U.S. markets. It's not guaranteed, and as everybody knows, if a lot of the tariff situation gets resolved, markets could take off to the upside. So there's that risk too. Okay, let me stop and we'll turn to Q&A now, and we'll go for about 15 minutes on that, and then let everybody go if you have to leave early. Thank you all for being with us today. Catherine, come on back and let's see if there are questions. There may not be.
Yeah, there was a few questions that came in during the presentation.
Yeah.
The first question
Oh, here it is. Yeah.
Yeah, my
I see.
concern is that my portfolio fell like a rocket when the tariff crisis arose, yet rose so slightly when the market rebounded. Can you explain?
I'd have to see the portfolio. Our portfolios, I don't think, reacted like that. And the market rebound was only very, very brief. Just a couple days ago, when President Trump announced the 90-day extension, the U.S. market rose almost 10%, but it was down 5 or 6% the following day. And so it was a short-lived rally. Market commentators will call that a bear market rally. It's a rally that can sort of suck people in and cause them to do a bunch of buying, and then the market falls further. I can't answer it because I'd have to see the portfolio and be able to identify what are the components that contributed to that. Sorry, I can't. If you are a client, I don't know if you're a client, but if you're a client or whoever you are, feel free to send me an email and we can take a look at the specifics of it. But absent details, I just can't comment. Okay, next.
Got it. Next one is we heard rumors that the FDIC.
Well, there it is.
Oh.
Yeah. So my comment is if FDIC insurance is eliminated, that means there's no backstop on bank deposits by the federal government, and you're completely at the mercy of is this a strong bank where you have your deposit or not? Now, we have the ability through Fidelity to split up bank deposits automatically among different banks. It's a really, really nifty thing. A lot of people don't know about it, that we're able to do that with Fidelity. Rather than you having to go and open bank accounts with 20 different banks, we can have one account for you, and Fidelity doles out your money to 20 different banks in one account. You don't have to do anything. And so it's a really, really powerful thing. So if you're interested in that, we can do that. But it's a great question, Gary and Mary Ellen. And it's sort of crazy too, because the federal government, to my knowledge, doesn't pay FDIC. It's basically an insurance pool that is paid in to by the banks themselves. Now, the federal government may have been on the hook for bank failures, even recent ones. I don't know. But if FDIC insurance is eliminated, we're back to the days of bank failures when people lost their money and couldn't get it back. So we are very alert to this. That's my comment. We are very alert. We will not allow clients to walk into that kind of situation. What would a tariff off-ramp look like? Is there one, is the next question. Well, it would look like negotiations, honest to goodness negotiations. They're saying that they're going to, I think the marketing buzzword of the administration today is 90 agreements in 90 days. Folks, it takes years to make trade agreements. Years and years and years to make a single trade agreement. These things are worked on forever, but I don't know, maybe they're going to do 90 one a day. But that is what an off-ramp is supposed to look like, or negotiations to put in place. Maybe they'll do it. I'm not gonna put it past them. But I wouldn't say that they have my highest form of confidence. Sorry, they haven't earned it in any way, shape, or form. But good luck. I hope they do. All right, next. How many bluffs or backdowns from tariffs or whatever policy announcements will cause future market reactions to be smaller? Ignore such policy announcements. Markets are one of the major checks and balances. That's exactly right. That's what I said. Will it last? Well, let me say this. Our markets are amazing discounting mechanisms. Amazing. They're operating they're operating, I'm a beekeeper, and they're operating like the hive mind of a beehive, right? They're that advanced. And so they are collecting all information. And so Scott, if the question is, if the credibility of this president and this administration is gone, and they're crying wolf, which I think many people might say is the case, then to whatever extent that is happening, the markets are going to discount that. They're going to discount that. I think the markets are going to get very, very good at being able to interpret when is Donald Trump saying something that he means, and when is he saying something that he doesn't mean. And so I think at this point, the best thing we can say is that the markets know best. They know better than me individually. They know, I think, better than anyone individually. They may even know better than Donald Trump himself, who at this point, I would say, doesn't really know even what he thinks. So I have a lot of faith in the markets to be able to ferret out almost every single one of these, what you call bluffs and backdowns. I agree with that. And the volatility of the markets, which is extreme right now and out of the ordinary, is a measure of the absolute disarray of the due process of this administration and this president. They are reflective of that. They are not a cause of it, and they are not broken in response to it. They are doing exactly what they should be doing, and we should be thankful for that. Because let's imagine we're back in 1700, or I don't know, when it was King Louis XIV of France, 1760 or 70 or something like that, And imagine this king is doing all this stuff, and there's no stock market, there's no bond market to say, hey, king, bad, bad, just nothing. There's just the court of the king coming in and saying, Your Majesty, if you'd awake from your nap, the people are upset. Let them eat cake. Right? So we want to be thankful for these markets because, Scott, as you say, they are one of the major checks and balances remaining. Okay, it looks like what are some of the safe havens for cash if I wanted to take my money out of American banks? Let's talk. Let's talk. I don't want to just start talking about safe havens and naming them because they may not be safe havens. And I'm in a deep think right now about safe havens. And so I don't want to lead anybody astray about that. For all I know right now, money is safe in banks. It's safe in money markets. We're doing a lot of cash management for clients. I have cash, and I am confident in cash right now. And let's not forget that while the Federal Reserve, I do not think, has any ability to help on the tariff crisis, if we have problems in the cash markets, you will see the Federal Reserve come off the sidelines and come off hard and fast. And you can have confidence in our Federal Reserve right now. It is still helmed by a very, very capable man, Jerome Powell, who Donald Trump wants to fire, but has already said, I will not be fired because according to congressional statute, the president cannot fire him, but we'll see what happens. And also a very, very capable board of governors of all political persuasions, conservative and liberals, and Republicans and Democrats. I have a lot of confidence in our Federal Reserve, and you can too right now. Any other questions right now? Anybody? Well, we've gone over, but not too much. I want to thank everybody for attending. We will continue to be in touch with you. You all said that this is going to be a long crisis, and I completely agree with that. We're with you every step of the way. I remind you that I am invested and my family is invested the way that you are invested. We may hold more stocks, or more of this, given our risk tolerances and risk capacity than yours. But that just means that, the milligrams of the medicine that I take may be different than the milligrams of the medicine that you take, but I take the same medicine. Okay, that's the important thing to know. So I'm in the same boat as you, and we are fiduciaries to you. We put your interests first, and we are so grateful for the trust that you have placed in us. We are waking up every single day and coming to work. I don't even call this the conference room anymore. I call it the war room, the tariff war room. And we come to the war room every single day, ready to do whatever battle we need to do to make sure that you get what you need. And we are available for individual consultations at any time. We're having a number of those with different clients who ask us, and we're happy to do it, whether that's in person or by Zoom. I hope you have a great afternoon. Please put some of this down. We got nice weather. With summer coming on, we're going to get some of our last cooler days. So please go out and do something fun and put the markets down. Thankfully, they'll be closed Saturday and Sunday. And hopefully maybe the administration itself will take a break and go enjoy something there in Washington, D.C. or wherever, but I doubt it. So, we'll be prepared for more news to come out. Thanks for joining us. Thanks to Catherine. Thanks to Jaycee for her presentation. Take care, everybody. And if there are any follow-up questions, feel free to contact me, email or otherwise. Thanks so much.